All right, let's talk about the wild world of DEX tokens. It can feel like pure chaos out there, right? But what if I told you there's a hidden pattern, a predictable life cycle that most of these tokens follow? Today, we're going to crack that code. By the end of this, you'll have a much clearer map to navigate this space. So let's jump right in. This quote right here, it's the key to understanding everything we're about to cover. We have to stop thinking about tokens in rigid boxes like utility token or governance token. Instead, think of it as a dynamic journey. Every token is on a path, moving through different phases from the moment it's created. So, here's our game plan. First, we'll get a handle on the overall token lifecycle. Then we'll dive into the explosive launch phase, followed by the emotional roller coaster of pumps and dumps. After that, we'll look at the long game. What happens when a token stagnates or tries to make a comeback? And finally, we'll cover the wild cards, narratives, and traps that can change the game completely. Okay, first up, the token lifecycle itself. The single most important idea to grasp is that these tokens are never static. They are always on the move, evolving from one phase to the next. And you know what? Each one of those phases has its own unique character, its own risks, and its own rules of engagement. So, at a high level, the journey usually looks something like this. It all kicks off with the launch. Now, if it catches on, if it gets that initial spark, that leads to a pump. And we all know, what goes up, well, it often comes crashing down, leading to the dump. And from those ashes, a token might just go into a long, quiet accumulation phase. Or maybe, just maybe, it stages a full-blown revival. This is the basic pattern we're going to be dissecting. Now, let's get into the most electrifying and frankly the most dangerous phase of them all. The launch. This is ground zero. It's the moment a token is born on-chain and trading officially begins. You see, a brand new token is basically a blank slate. The market cap is tiny, which means even small buys can send the price absolutely rocketing. There's zero price history, zero chart to look at. Liquidity is paper thin. It's just pure, raw, chaotic price discovery as the very first buyers and sellers duke it out. And this creates the fundamental tension of any new launch. On one hand, you have this massive, almost lottery ticket-like opportunity for insane gains. But on the other hand, you have an equal amount of extreme danger. And I'm not just talking about the price crashing. We're talking about fatal flaws in the contract or the classic rug pull, where the developers just drain all the money and disappear. So after that initial storm of the launch calms down a bit, a token usually enters its next phase. And this one is all about human emotion. This is where trading psychology, momentum, FOMO, and outright panic take over and become the main drivers of the price. First, let's look at the post-pump token. You've seen these charts. They're the ones with those gigantic vertical green candles. The early buyers, they're sitting on huge profits. And now the rest of the market sees it, and the FOMO crowd starts piling in, desperately chasing that rocket ship. This creates the absolute critical question for any trader in that moment. Is this thing going to keep running? Is there more fuel in the tank for a continuation? Or are those early buyers getting ready to sell, to distribute their bags onto the heads of all the new late buyers? It is a classic knife's edge decision. And then you have the inevitable flip side, the post-dump token. The chart looks like it just fell off a cliff. We're talking catastrophic drops, minus 50, 60, sometimes even 90%. Panic is thick in the air, and for most people looking at it, the project looks totally, completely dead. But again, it's never that simple, is it? You have to ask, is this a genuine dip-buying opportunity where the smart money is just shaking out the weak hands, or is this the final nail in the coffin for a dying project? Let me tell you, blindly buying these kinds of dips is one of the fastest ways to burn through your capital. All right, so let's say a project actually survives that initial pump and dump cycle. It can then enter a much quieter, more mature phase. This is the long game, and this part is a real test of a trader's patience and their ability to perceive what's really going on under the surface. This table really breaks down the two main paths it can take. First, you have the accumulation phase. Honestly, it's boring. Volatility is low, the chart goes sideways, volume dries up. It feels like absolutely nothing is happening. But beneath all that, patient investors might be quietly building their positions. Then you have the potential for a revival or a second run. Suddenly volatility picks up, hope returns, but so does a healthy dose of skepticism. Is it going to break out and make a new high, or is this just a classic dead cat bounce before it fails? So how do you even begin to tell the difference? Well, smart traders look for concrete signs. Is real trading volume starting to come back? Is the chart structure actually improving? Is it making higher lows instead of just bleeding out? And what about the social buzz? Is the community coming back to life? Spotting a true revival is one of the hardest skills to learn, but these are the clues you look for. Now, here's where things get tricky. Not every token follows that neat little life cycle. There are these powerful outside forces, these X factors, that can come in and totally override the normal flow. Let's talk about the two biggest ones: narratives and straight-up traps. Narrative-driven tokens are all about the story. Their price isn't really tied to any fundamentals, it's tied to hype and attention. Think about the big sector trends like AI or GameFi or a powerful meme that just captures everyone's imagination. These tokens can run unbelievably hard, but only for as long as that story is hot. The second the narrative fades and attention shifts somewhere else, the liquidity can just evaporate. And then we have the really dark side of crypto. Some tokens aren't designed to be traded at all. They're built from the ground up to be traps. We're talking about things like honeypots, where you can buy in, but the code literally won't let you sell. Or projects that fake their liquidity and use bots to create artificial volume to look legit, right before the developers pull the plug. And here's the absolute bottom line for these kinds of tokens. Your technical analysis, your beautiful chart patterns, they mean nothing. A chart that looks like it's about to go to the moon is worthless if the smart contract is a trap. In these cases, security analysis isn't just important, it is everything. Okay, we've gone on quite a journey here, from the birth of a token all the way through its potential revival or death. Let's bring it all together. What is the big picture? The main thing to take away from all of this? It really boils down to the simple risk-reward framework. In the early stages, that launch and the first big pump, you have the highest possible reward, but it comes with the absolute highest level of danger. As a token gets older and moves into those later stages, that explosive, life-changing upside is often gone, and the probability that it's just a trap or a project that's slowly fading away actually increases. Being a successful trader is all about knowing which stage you're operating in. And that leaves us with one final thought. The most important question you can ask yourself isn't just what token is moving, it's why is it moving? Is it a brand new launch? Is it riding a hot narrative? Is it a revival attempt from the dead? Once you start to understand this life cycle, you can begin to see the story the chart is telling you, and that changes everything.